Good afternoon, everyone. Today we're going to take a look at the what's usually the very last model of the entire AP Macroeconomics course, or at least it's the thing that I teach last, and that is the foreign exchange market, often abbreviated the Forex market. So the foreign exchange market is related to the balance of payments. So these two things usually go together, one on one day and another on another day. The foreign exchange market basically tracks the market where currencies are exchanged for other currencies. And the foreign exchange market isn't one monolithic market, but it's actually a whole collection of markets. Each pair of currencies has its own separate foreign exchange market where those currencies are traded for each other. So there's a foreign exchange market for dollars to euros, which is the one we're going to look at today. There's a foreign exchange market for dollars to pesos, for dollars to yen, for dollars to yuan, et cetera, et cetera. So it's the foreign exchange market, but it's really a whole bunch of markets kind of operating alongside each other, trading currencies into lots of other different types of currencies. One of the questions I have a lot of students ask is, why would I ever want to trade good old-fashioned American dollars for some other kind of currency? Like, why would I even want to do that? And so the main drivers of the foreign exchange market are going to be international trade is by far the biggest. So we buy a lot of imported goods from overseas, and if I'm going to go and I'm going to buy socks from a company that produces socks in China, that company who produces socks in China doesn't accept US dollars in payment for their goods and services. They want Chinese yuan. And so in order for me to do business overseas, I need to enter into the foreign exchange market, turn billions and billions of US dollars into Chinese yuan so that I can then purchase Chinese goods in their home currency. So international trade is a big driver of the foreign exchange market, especially when we're talking about businesses, a business like Walmart or Target that's buying literally hundreds of billions of dollars worth of goods and services from other countries every single year. They spend a lot of time and a lot of effort on the foreign exchange market, turning their dollars into the currencies they need to purchase the products that they want to put on their shelves. The second big driver of the foreign exchange market is going to be investment. In our increasingly globalized world, you're not limited to putting your money just in U.S. banks or just in U.S. savings bonds or just in the U.S. stock market for that matter. And so investment also drives foreign currencies. If I wanted to invest money in the stock market into a Chinese company or a Japanese company, that if the stock is traded on their stock markets, you need to purchase those stocks in their home currency. Because if I want to buy Chinese or Japanese stock, I need to go to the foreign exchange market and turn my dollars into yen or turn my dollars into yuan in order to make those purchases. The same is true if I wanted to hold my money in foreign bank accounts. I need to deposit that money in their home currency as well. So investment, sales of stocks and bonds and savings accounts and CDs and all these other things also drive the foreign exchange market. And last, but probably the easiest to understand, and definitely the least of these, is going to be travel. So if you go somewhere else, you often need to change your money so that you can make purchases in the local currency. It's not a statistically significant chunk, like there's not that much travel going on, but it still is something worth noting, and it's something that shows up. I mean, it's dwarfed by the size of our international trade and investment, but it's still an important source of demand on the foreign exchange market. Now, the weird thing about the foreign exchange market, there's a couple of weird things about it. Let's start by taking a look at the two markets that I've drawn here. In reality, these aren't actually two markets. So we see the market for dollars and the market for euros. What this is one foreign exchange market. It is the market in which dollars are exchanged for euros and euros are exchanged for dollars. But we draw it as if it's two separate markets because we're taking basically two different perspectives on the exact same transaction that's going on. So these are two different representations of the same thing happening, one from the perspective of the holders of the dollars and one from the perspective of the holders of the euros. So one weird thing about the foreign exchange market is when we draw it, we really draw it as two separate markets. The kind of weird thing is the AP exam doesn't ask the students to draw both halves of the market because it's going to be a little redundant, as we'll find out in just a second. If I know what's happening to one, I automatically know what's happening to the other. And so the AP exam will only ever ask them draw the market for dollars or draw the market for euros, never draw both. But we never know exactly which one the AP exam is going to ask them to draw, so I like to teach both halves of the market so that they kind of understand the macro perspective of what's going on, so no matter which side they're asked to draw on, they're able to do that. I think it would be a mistake to always draw the market for dollars because they're not necessarily going to be asked to draw the market for dollars on the AP exam. They might be asked to draw the market for other things. So we're looking here as a foreign exchange market for dollars to euros. You will notice the x-axis of both of these markets here just have quantity of dollars and quantity of euros. What's on the x-axis, that information is not particularly useful to us. We don't really do anything with that. So it's nice to know that the quantity of dollars being exchanged is going up or down, but it doesn't really affect us. That's not the part of it, the piece of information we care about. The piece of information we care about is the exchange rate, and this is what goes on the y-axis. Students very often, they can tell you what an exchange rate is, but they have some difficulty like actually conceptualizing that and explaining the exchange rate. So rather than just writing exchange rate on the y-axis like the AP exam does, I always make the kids write out exactly what the exchange rate means. So the exchange rate for dollars on our top graph there is the number of euros it takes to purchase $1. The other way to say that is the dollar price in euros. The easy way to remember it is whatever market you're looking at, that's the currency that's going to equal 1 on the exchange rate. So if it's the market for dollars, then it's how many euros does it take to buy $1. And on the bottom, if it's the market for euros, it's the number of dollars it takes to buy €1. Always make the students write that out because they're going to get confused later on, especially on the multiple choice portion of the AP exam. It'll be like, if the euro goes from $1.10 to $1.60, has the euro appreciated or depreciated? And not being able to draw the graph correctly will sometimes hinder the students from being able to answer those questions. So make sure they know that the exchange rate for dollars is the price of dollars in euros or in whatever the other currency is. And the exchange rate for euros is the price of euros in dollars or whatever the other currency is. And this is the thing we really care about because exchange rates are going to affect aggregate demand that we'll get to a little bit later on. Okay, the next thing we're going to add here is we're going to start off by just adding one curve on each graph. So on the market for dollars, we've got the supply for dollars, and on the market for euros, we've got the demand for euros. Now you notice that I have color-coded these the same color. I think that's going to be really important. So I highly recommend when you introduce this to the students, you color-code supply on one side the same color as demand on the other side. The reason being, the students need to understand the basic concept that the supply for dollars available to be turned into euros is fundamentally the same thing as the demand for euros to be turned into dollars. So if you think about it, let's say that I'm engaging in international travel and I show up in Paris and I need to get some euros so that I can buy a croissant. When I show up in the airport and I have US dollars and I hold up those dollars and I'm like, hey, I've got dollars, somebody give me euros. I am simultaneously supplying dollars, because that's what I have, Americans supply dollars, because that's what we have, but I am also at that exact same moment demanding euros. So I'm supplying dollars to be turned into euros and demanding euros to be turned into dollars simultaneously. So although these show up as two different curves on the two different markets, they're actually the same thing. The supply for dollars is the demand for euros on these markets, and because of that, they'll always have a direct relationship to each other. So if all of a sudden I increase the supply of dollars available to be turned into euros, I am simultaneously increasing the demand for euros to be turned into dollars and vice versa. So we supply our home currency and demand the foreign currency, but our supplying of our home currency and our demanding of the foreign currency are fundamentally the same thing, and they will always do the same as each other. So if one shifts right, the other shifts right. If one shifts left, the other shifts left, and that is an important concept. Similarly, I like to color code the demand for dollars and the supply for euros as the same color as well, keeping in mind that on the market for dollars, Europeans are demanding dollars to be turned into euros, and Europeans are supplying euros to be turned into dollars because they have euros, so they're supplying the euros, and they want dollars, they're demanding the dollars. So once again, just like the previous pair, those are fundamentally the same thing, and they will do exactly the same thing as each other. The next thing the kids need to know about is what happens when your currency appreciates and depreciates. But before we can get to that, we want to go ahead and define what those terms mean. So over on the market for dollars, I went ahead and pointed out what appreciation, depreciation looks like. If we're following that equilibrium point, if the equilibrium point is moving upwards from where it originally was, then the currency has appreciated, meaning that it's taking more euros to buy a dollar. And if that equilibrium point falls, goes lower from where it was originally, we say that our currency has depreciated, meaning it's going to take fewer euros to buy the dollar. So currency appreciation occurs when your currency is worth more. And what that means in the context of the exchange rate is that it takes more of a foreign currency to buy yours. So if it takes more euros to buy my dollar than it did before, the dollar has appreciated. The other side to that is depreciation, when your currency has lost value. And on the market over here, it looks like that when it takes more of your currency to buy foreign money. One of the important things to note is that for these currency pairs, in this case it's dollars and euros, one of the currencies will always be appreciating and the other currency will always be depreciating. And we'll show why that is in just a second. But if I know the dollar is appreciating versus the euro, I automatically know the euro is depreciating versus the dollar and vice versa. That's kind of just a logic puzzle there. So they need to be able to recognize that when the equilibrium point moves due to shifts in supply and demand for these currencies, what that is going to do to the overall value of those currencies relative to each other. And they need to know that it's not called goes up in value or down in value. The proper terminology is currency appreciation and currency depreciation. All right, once we understand the basics of appreciation and depreciation, we then need to go over what are the determinants that will cause exchange rates in the foreign exchange market to change. Now, this is going to be a really big difference for the kids from the way that we've dealt with models that look like this in the past. The big difference is that on the foreign exchange market, because it's two different exchanges, dollars for euros and then euros for dollars, there aren't going to be determinants of supply and determinants of demand presented separately the way they are for pretty much every other model we've done this year. Because there's two halves to the market, all of these determinants will always change supply on one side of the market and demand on the other side. Because remember, for example, the supply for dollars and the demand for euros are the same thing. So any determinant that affects supply for dollars also affects demand for euros. So there aren't a separate set of supply and demand determinants the way that they're used to. So what we have here is basically what they need to know isn't whether it shifts supply or demand. What they need to know is what happens to the value of the currency. So rather than memorizing leftward and rightward shifts, we're going to memorize does the currency appreciate or depreciate based on these various factors. And the kind of cool thing about it is once they know whether the currency appreciates or depreciates, they can actually answer either the change in supply or the change in demand that gets them to that level of appreciation or depreciation. So the AP exam, let's say that the euro appreciated. The AP exam would accept the euro appreciated due to a reduction in the supply of euros, or they would also accept the euro appreciated due to an increase in demand for euros. And as long as the explanation portion on the FRQ was correct, they accept both of those as correct answers. So it's kind of cool in that all they have to know is whether the currency is going to appreciate or depreciate, and they can figure out why later on. But it is a big change from the way that we presented things up until this point in the course. And so students are going to be a little bit resistant to that because they're used to just memorizing supply and demand determinants. So all they really need to know is which currency is appreciating and which currency is depreciating. And once again, one of these currencies will always be appreciating and the other will always be depreciating based on each of these determinants. So determinant number one is going to be change in inflation. This is going to be relative inflation between nations. People do not want to hold on to currency that is experiencing high levels of inflation. So if a currency is experiencing high levels of inflation relative to another, you will see people in that country get rid of their currency. So you'll see the currency experiencing high inflation depreciating because nobody wants it anymore. And you'll see the currency that is relatively stable when it comes to inflation appreciating. So high inflation rates cause currencies to depreciate, and relatively low inflation rates cause currencies to appreciate. The second major determinant is going to be changes in interest rates, and this has to do with that investment portion that we talked about a little bit earlier. Investors who are holding on to these currencies want to receive a higher interest rate on their investments. And so generally speaking around the world, you'll see currencies chase higher interest rates as long as they're higher and relatively safer interest rates. So if one country has a high interest rate relative to another, the country with a higher interest rate is going to see their currency appreciate as citizens from the other country attempt to put their money into the higher interest rate banking system or higher interest rate bonds or higher rate of return stock market. So countries with higher interest rates or higher rates of return see their currency appreciate. If you've got low interest or low rates of return, you will see your currency depreciate. The third one is going to be trade, which we're going to call our current account deficits and current account surpluses from the last video. Countries that have large current account deficits see their currencies depreciate relative to their trading partners, and countries with large current account surpluses see their currencies appreciate relative to their trading partners. So basically, exports are good for the value of your currency, and imports are bad for the value of your currency, kind of long story short. The fourth major determinant is going to be basically just stability across the board. So political stability, economic stability. The AP exam likes to add in large budget deficits as part of the political and economic stability as well. Generally speaking, people want to hold currencies that belong to countries that are relatively stable. So stable countries that aren't on fire all the time tend to see their currencies appreciate. Whereas if you have economic instability like a recession, or political instability like a coup d'etat, or budgetary instability like high budget deficits, that's generally a red flag to people holding onto that currency. And so instability generally causes your currency to depreciate. Last but not least, and probably most complicated, we have changes to the terms of trade. So these are going to be things like tariffs, quotas, embargoes, those types of things. So any type of like trade barriers that countries can put up with other countries is going to impact the flow of goods and services between those nations, which will eventually end up impacting the value of their currencies relative to each other. So if you get terms of trade that are going to change, you have a new trade deal or an embargo or sanctions placed on a nation, that's going to affect the overall value of those currencies. Generally speaking, terms of trade changes cause the currency of the country that benefits from those changes to appreciate, and the currency of the country that is kind of harmed by those changes to depreciate. So favorable terms of trade cause your currency to appreciate, less favorable terms of trade cause your currency to depreciate. The kids don't really need to know why. It probably won't come up, but just in case it does, have them memorize that. Last thing we want to talk about, and I'm going to switch pages here because we're out of room, is what is the impact of changes in the value of your currency to the aggregate demand curve and GDP in your country. So I'm going to switch pages for that, and I'll be right back. So the final part of this lesson, we then need to kind of tie it all together. So we went over the foreign exchange market and what are the determinants that cause currencies to appreciate and depreciate. The final thing the kids will need to be able to do is to connect the appreciation, depreciation of their currencies to impacting the aggregate demand curve. And so we learned a long time ago the factors that affect investment spending, predominantly monetary policy, and we learned the factors that affect government spending and consumer spending, predominantly the budget and tax policy. And so we know 3 of the 4 things that change aggregate demand, and the last thing that's going to help us to understand it is what affects net exports, and predominantly it's going to be changes in the foreign exchange market that drive changes in net exports. So we're finally filling in that missing gap from a long time ago in the course, where we can finally figure out what is the 4th real driver of aggregate demand, and we can model that out to figure out what happens to aggregate demand when net exports change. Long story short, most Americans tend to think that a highly valued currency is a good thing because most of us are coming from the point of view of a consumer. And when your currency is highly valued, consumers tend to benefit because it makes imported products relatively less expensive. However, we need to get away from the mindset that strong dollar is good and weak dollar is bad, because in reality, the impacts of changes on the foreign exchange market are a lot more complicated than that. So when a currency appreciates, what we call the strong dollar, 2 things happen simultaneously. Imports into the country whose currency appreciated become relatively less expensive. So for consumers, this makes us happy. I can buy imported cars from Japan or imported textiles from Vietnam at a lower price than I would otherwise be able to because my currency has gone up in value relative to theirs. But at the same time that imported goods become more affordable, your exports to those countries become less affordable to people in those countries. So when we have a strongly valued currency, other countries' citizens tend to not buy our products because our products are relatively more expensive than products coming from other countries. And that can be a major, major problem, especially if you're an export-oriented industry or you're a producer of products that relies on foreign markets. This can really hurt you, and you don't really have any control over it. So when your currency appreciates, we expect to see increases in the level of imports into your country and decreases in the level of exports out of your country. If you recall way back from the aggregate by aggregate demand lesson, net exports is equal to exports minus imports, so X minus M equals XN, resulting in an overall reduction in net exports, which, because net exports is a determinant of aggregate demand, will cause the aggregate demand curve to shock to the left. So we see the graph here, a reduction in aggregate demand occurring because imports are increasing and exports are decreasing simultaneously. So, on kind of a macroeconomic perspective, currency appreciation isn't really good for the macroeconomy. It actually lowers GDP and harms productivity in the economy, even though it may be at least temporarily good for the consumer because they can afford cheaper imported goods. It's very bad for producers and any export oriented industries. So, you don't necessarily want to have the strongest currency in the world, or you'll find it difficult to sell your products overseas. I don't want to repeat everything that I just went through, but when your currency depreciates, basically the opposite of all that happens. So you have an overall increase in net exports due to reductions in imports and increases in exports, causing increases in aggregate demand and increases in GDP. Now, when you have a low valued currency, what we call the weak dollar, this is good for producers and export oriented industries, but it's bad for consumers because we can't afford to buy as many imported goods and services. So it may be good kind of on a macroeconomic sense, but consumers really feel the pain here and aren't necessarily happy about the resulting increases in price. Another important thing to point out to the students is that when your currency fluctuates on the foreign exchange market, although it affects the value and the cost of imported goods, it doesn't really affect the price of domestically produced goods that you're buying domestically. So a change in the foreign exchange market isn't really going to change the price of Fords that are produced in the United States and purchased in the United States, though it would impact the price of Toyotas that are imported from Japan. So this doesn't really affect domestic pricing, only the pricing of imported goods and services. So basically, that's what they need to know about the foreign exchange market. They need to know what it is, how to draw it, what causes currency appreciation and depreciation, and then they need to be able to explain how those currency appreciation and depreciations impact the aggregate demand curve. And if they can do all those things, you are basically done with the course. Congratulations, you have made it.